Hello everyone. In this video, we will cover endowment insurance. Consider an end-year endowment insurance of one issued on a person at age X. For endowment insurance, the insurer will pay $1 at the end of the year of death if the person dies within the end-year period, or the insurer will pay $1 as survival benefit if the person survived by the end of the end-year period, whichever occurs first. Let Z be the present value random variable for this insurance. That is, if the person dies within the year before reaching age X plus 1, the present value of the policy is nil with probability QX. If the person dies within the year before reaching age X plus 2, the present value for this policy is nil square with probability 1 bar QX. If the person dies within the year before reaching age X plus n minus 1, the present value is nil to the power n minus 1. The probability is n minus 2 bar QX. If the person can survive beyond age X plus n minus 1, then this person or the insurer will definitely need to pay the $1 at time X plus n. The present value is nil n. If the person dies within the year before reaching this age X plus n, we have Kx equals n minus 1, or else if the person survives beyond age X plus n, we have Kx greater than or equals n. Here, receiving this $1 either as a death benefit or survival benefit, the probability is n minus 1 px. And therefore, Z will have this PMF. We can regard the endowment insurance as the sum of an n-year term insurance. Here, I denote it by Z1 with this PMF, and an n-year pure endowment, Z2, with this PMF. And therefore, the expected value of Z is the expected value of the n-year term insurance, Z1, plus the expected value of the n-year pure endowment, Z2. In terms of the notation, for endowment insurance, we have this big A notation, A X colon angle N. There's no 1 above X or N. And then the expected value of Z1, the n-year term insurance, we have the big A notation, the 1 above the X. And the expected value of Z2, the big A notation for the pure endowment, the 1 above the angle N. Similarly, the second moment, the expected value of Z squared, which is equals to the expected value of Z1 squared plus the expected value of Z2 squared. The notation, we have the pre-superscript 2, and then the big A notation. And this is the expression. We get the second moment and the first moment of Z, we can get the variance of Z. Let's consider a special endowment insurance. For special insurance, no matter this is for term insurance, endowment insurance, or life insurance, this corresponds to the death benefit not equals 1, or the benefit is not a constant equals 1. Okay, so here we have a special endowment insurance. The insurer pays B1 at the end of the year of death, or pays B2 upon the survival by the end of the n-year period, whichever occurs first. Let Z be the present value random variable for this insurance. And we have the PMF here, the death benefit B1, the corresponding present value is B1 due to the power Kx plus 1. And then the survival benefit B2 times nu to the power n. This can be regarded as the sum of the n-year term insurance and the pure endowment. So the expected value of Z, this special endowment insurance, is also the same. okay, equals to the sum of the expected value of Z1 and the expected value of Z2. Let's take a look at an example. A special N-year endowment insurance on X pays a pure endowment of 800 at the end of N years and pays 600 at the end of the year of death if death occurs. Therefore, this $800 is the survival benefit and the $600 is the death benefit. The present value. The single net premium for this insurance is $500. And another insurance, the single net premium for an N-year endowment insurance of $800 with death benefit payable at the end of the year of death. For this policy, the death benefit and the survival benefit is $800. And the present value or the single net premium for this policy is $590. We are asked to get the single net premium for an N-year pure endowment of $800. All right, so we need to get this notation, okay, the quantity of this. For the first policy, we have the pure endowment of 800 and then a term insurance of $600 and N-year term insurance. The expected value of this is 500. And then the second policy, an endowment insurance of 800. The present value is 590. And then for endowment insurance, this can be written as the sum of the pure endowment and the N-year term insurance. All right, so we have two equations and two unknowns. We can solve for AX angle N with 1 above the X. So this is a N-year term insurance equals 0.45. And then the N-year pure endowment is 0.3625. What we need to get the N-year pure endowment with benefit 800. So we need to take the 800 multiplied by 0.3625. And then we get the answer 290. All right, another example. Given that Q40 is 0.02 and the rate of interest is 0.1, we are also given that the endowment insurance of 1 issued to a person at age 40, and this is a 3-year endowment insurance. The expected value is 0.7565. And we want to get the 3-year endowment insurance issued on age 40 using the interest rate 0.11. All right, so the person currently at age 40, if the person dies before reaching age 41, the probability is Q40. And so we have the first term, U times Q40. And then plus the second term, the person dies within the year before reaching age 42. K40 equals 1 with probability P40 times Q41. So the second term will be nu square times P40 times Q41. And then the last term, as long as the person survives beyond age 42, then the policy holder can receive the $1 at this time point by age 43, no matter the person dies or survives. The probability is P40 times P41. The last term in the expression is U to the power 3 times P40 times P41. Substitute the numbers. I is 0.1 and Q40 is 0.02. So we get the first term. The second term, we have Q40 0.02, and therefore P40 is 0.98. And we don't know Q41. And then the last term, P40 is again 0.98, and then we need the quantity for P41. So we need to get Q41 and P41, but P41 equals 1 minus Q41. And the expected value for this endowment insurance is 0.7565. So from here, we can get the value for Q41. Q41 is 0.027566. And then we get all the information, and then we can recalculate this endowment insurance using the interest rate 0.11. The same expression, same quantity, except that U here is 1 over 1 plus I, which is 1 over 1.11. And upon calculation, we get the answer. At interest rate 0.11, this endowment insurance, the expected value is 0.7368. That's it for today's video. Thank you for watching, and see you in the next video.